Record. Thank you. Okay, welcome everybody. So today we're very pleased to have our first tandem talk at Tandon, and it's being given jointly by Leon Tadavasi and Scott Bukta. I'll introduce Leon and he'll introduce Scott. So Leon is an adjunct professor in finance and risk engineering at NYU Tandon and in the math and finance program at Perrant. So from 2009 to 16, Leon was a director in group risk management at RBC Capital Markets, where he focused on market risk for securitized products and secondary trading, origination, and prop trading areas. His 27 years of experience in the fixed income capital markets includes positions as a trader, quant strat, derivatives modeler, and market risk analyst with product background in U.S. Treasury securities, U.S. agency securities, interest rate derivatives, MBS, ABS, and credit derivatives. In 2006 and 7, he was principal senior trader in the asset securitization and principal investment group at Bank of America Securities. He graduated from MIT and was in the PhD program in math at Brown University. Leon, please take it away.
Thank you very much, Peter. Hello, everybody. Thank you, Peter, again for inviting us. It's always wonderful to interact with people in the FRE group department. We hope we can get back in person pretty soon. I'm very happy to introduce my colleague Scott, who will be speaking with me. Scott Bukta is Senior Managing Director and Head of Fixed Income Strategy at Breen Capital, LLC. He has 34 years of experience developing strategies for institutional clients across the various fixed income sectors with an emphasis on MBSs, CMBSs, and other structured products. In addition to providing market insight and cross-sector relative value ideas, he also provides periodic commentary on macroeconomic themes, interest rates, mortgage prepayments, and the housing markets. Prior to joining Breen, he was a Senior Managing Director at Bear Stearns in the FAST, Financial Analytics and Structured Transactions Department, where he headed up the mortgage products group and was a senior member of the portfolio strategies team. He holds a Bachelor of Science in both computer science and finance from Carroll University in Wisconsin. Okay, welcome everybody. We're going to talk about kind of a timely theme right now in the fixed income markets, this concept of convexity-related exaggerated market moves in the rate market. So let me share my screen here, and we will start. Okay, slideshow from beginning. Okay. Okay, does everybody see this? Does everybody see the PowerPoint?
All good.
All good? Okay. Okay. So we tried to come up with a provocative title. Can we still blame MBS hedgers? And we'll tell you what that's all about. Okay. Okay. So, I mean, for many, many years, people have sort of realized that there's this interdependence between what activities of sort of so-called mortgage rebalancers and the directionality and the magnitude of interest rate movements. So this is we'll talk about this in great length, but the concept basically is that a big block of interest rate risk in the fixed income markets, namely that which is warehoused in the mortgage space, has a dynamic attribute to it where the rate risk migrates with changes in rates. And this directionality is adverse from the point of view of the bondholder. And thus, when rates are moving in one direction, you've got action on the part of these rebalancers, which exaggerates the move, and similarly, the rates move in the other direction. So when things are stable and people sort of have confidence in prepayment, I don't want to call it prediction, but at least the integrity of the models and kind of the stability of the parameters, this is always there. But, you know, the toolkit seems to be, and Scott can speak more about this, fairly reasonable in its ability to advise people on how to react to this, you know, fundamental market reality. But when rates move unexpectedly, people revisit this issue to see whether maybe the models need to be adjusted, especially when we're in a regime of maybe unfamiliar rate environment or spread environment, and people start questioning whether, you know, the models maybe are no longer as valid as they had been in prior regimes. And this is particularly difficult because you've got a whole variety of factors about the MBS market, both aggregate, kind of like descriptive as well as analytical, that interact in trying to estimate this. So it's kind of a timely subject right now because we've had this last leg up in bond yields in the last handful of months. The big change in the scene has been the fact that with the QE program, $40 billion of papers being removed from the market every single month, net of actual principal redemptions, quite a large amount. And that combined with the fact that one of the active rebalancers, which were the Fannie, Freddie Mac, the so-called GSEs, have been consistently reducing the size of their asset portfolios. Significant. Hello? You want I'm going to go on mute, please? Yeah. And have been reducing, thank you. They've been reducing their asset portfolios aggressively, really since 2008. Yeah. And now there's commentary that the big part of their overall risk simply is the fact of their, could you put on, Armand, go on mute, please? Go on mute. Okay, a very big part of their business right now, and their risk is really just simply the fact that they're guaranteeing mortgage pools, so-called guarantee business. So, and with that preamble, the question is, can we still blame the MBS rebalancers for having an outsized effect on the directionality of rate movements? Okay, now who are the people who rebalance? So this is very rough. We can divide up the universe of mortgage holders into three categories. Federal Reserve right now is obviously a big player, bank portfolios, and money managers, REITs. The Fed, as we all know, and it's been in the news quite a bit, they do not engage in duration hedging. Originators do, of course. Those are the ones who produce mortgage raw material that goes into the capital markets, and they typically do use pass-throughs for the most part for the short-term management of this pipeline until the period, either when they're giving commitments or they're holding paper subject to ultimate securitization. Bank portfolios do use some rate product based hedging. They don't typically hold the mortgage portfolios on a trading basis available for sale, but they also respond to other drivers, not strictly duration rebalancing. In particular, they make judgments across the curve between 15 to 30 year, between hybrids and fixed rates and things like that. So that's kind of overlaid what they're doing on the rebalancing side. Sell side desks, which, Scott and I come from, they do use duration rebalancing, typically with empirical duration, which we'll talk about. And they're, of course, less of a player right now because of general reduction of balance sheets across the sell side. The GSEs were for many years the marginal, somewhat at times the most aggressive buyers of mortgages, and they were active users of rate options to stabilize their duration. Their impact is much less dominant now for the reasons that I talked about earlier. And there are some specialized markets like servicers, servicing like assets that have kind of exaggerated or leveraged exposure to, well, rates and prepayments. And, we sort of depend more on models to make sure that we sort of are able to track how those durations are responding to rate moves. Scott, do you want to comment a little bit on this page, please?
Yeah, so I think the big thing that we look at here is and how things have changed, but you really want to see who the biggest holders of mortgage-backed securities are, and then who the biggest hedgers are. And I think Leon hit it right on the head. The big change we've seen from probably the early 2000s was the fact that Freddie and Fannie had the biggest portfolio and they actively hedged their duration, where right now the biggest holder is the Fed, who does not hedge their duration. But that being said, there still are a number of these types of accounts that do actively hedge. And as durations move of the underlying assets, especially in a quick move like we just saw, you do see large flows hit the market one way or the other in treasuries as a result of just the underlying duration profile of the assets they hold. One other thing that we can think about in here where you've got dynamic hedgers for sure is actually these mortgage servicers. And servicing, when you think about it, there's probably about $7 trillion worth of agency MBS in the market today. And servicers hold a small servicing strip on that they have to hedge. Now, these are actually going to be the opposite of mortgages, so to speak, where they're going to hedge against rates down when bonds get called away. So they'll add more rate hedges on the buy side when rates go down. But when rates go up, what's really interesting is they perform really well in their servicing portfolio. But from an accounting point of view, they actually have a lower cost or market constraint. So what might happen is there's been so much servicing. We had about $3 billion or $3 trillion worth of issuance last year. Is when these servicers hit that book value on their servicing, they have to sell their hedges, because at that point they start losing money. So you've got a very technical dynamic. And I think that's part of what's happening right now with these servicers that a lot of people don't think about. But from an accounting point of view, they're actually forced to take off these hedges, which exacerbates selling in the market.
Yeah, and also, I guess, Scott, you also have a sort of less depth, I guess, in the ability of servicers to manage fundamental servicing like risk, because in other words, there's much less trading right now in some of the traditional strip products, that used to have before.
Right.
There are some derivatives, I guess, but I don't know to what extent people view them as being substitutes for what they used to have before, and the ability to trade, like trust IOs, which were kind of like the fundamental representations of where value was in servicing or servicing like assets.
Right. You've definitely moved to the rates market.
Exactly. That's right. Exactly right. Yeah. Okay. So what we're going to do, by the way, is later on in this talk, we are going to talk about various of these constituencies and what the market is saying right now about where they are in this domain. In other words, do we basically see, because of the way they're positioned, exaggerated awareness of this effect, or for some reason are they actually in a more benign position? I'll talk a little bit about that later on, as well as some historical perspective on how some of the big players were when we had prior periods of both rate movements as well as concerns about the ability to predict how mortgages will behave in the face of those rate movements. But let me sort of jump ahead a little bit to one specific, since we did mention trading or trading like accounts. I'd like to have Scott speak a little bit about one very fundamental type of trade, which is engaged into by all types of players on the sell and certainly on the total return buy side, and kind of like how that kind of fundamental trade in mortgage space has to be kind of like monitored in a more systematic way in the face of a rate changing environment. So Scott, you want to talk a little bit about basis trading?
So one of the fundamental trades that we talk about in mortgage space is basis trading, where you would be long the mortgage basis, meaning you're long mortgage-backed securities. Typically, you're long the production coupons, which tend to be the most negatively convex, and we're going to talk about that in a little bit. But right now, what the Fed has done is they're buying 40 billion net a month, but they're also buying about $100 billion worth of mortgage-backed securities a month, including reinvestment. So they're buying about 50 to 60% of overall production. So they're a huge footprint here. But because of all this demand, it's caused spreads to tighten. And in the mortgage market, there's things called dollar rolls, where you can finance either through repo, or you can roll bonds. You sell bonds in the front month and buy them in the back month. If people are short mortgages and they need to buy bonds in the front month, they're willing to give you better financing to buy bonds from you today and sell them back from you a month from now. So everybody that's selling to the Fed is short. And what this does is it creates a specialness in this market. So an investor that's long the basis, and you think about being long mortgages and borrowing money in repo, can actually get a better rate in these dollar roll markets. So it actually might give you financing at negative 50 basis points. So it increases your net interest margin. Because that exists because of the Fed, this basis trading has really grown. And it's not only primary dealers, who I'm going to show you on the next slide, literally are long about 50 billion basis, but hedge funds especially as well are long a lot of these basis trades, and they're long mortgages, they're short treasuries, they're collecting the carry, but they must actively manage that convexity and that duration. And the thing to think about in the levered mortgage environment is a levered investor like a REIT or a hedge fund could potentially take $1 billion worth of capital and buy $10 billion worth of mortgages. So you've got a levered exposure to rates at this point, which can really exacerbate moves at key thresholds in the market.
Yeah, and there are two key points that Scott made, which we'll talk about in a little bit more systematic way later, which is the following. You have a repricing of the rate market. Now, the question is, and we'll talk about this a little later on, what is happening to relative value in the face of that rate repricing? I mean, certainly you can imagine if the capital markets are making mortgages look more expensive in the face of a rate move, or whether it's due to financing reasons like with the roll or otherwise, that is going to have an effect on their convexity response. So one question you have to ask, if you want to look on a forward basis, is what will mortgages do as far as valuation in the face of higher yields? If they'll move in one direction, OAS will get better, stronger. That will have one effect on the convexity or the change in duration. If the mortgages cheapen up, that will have another effect. Similarly, on the financing side. So you can, it's a bunch of moving parts that you have to interpret in combination, interdependencies, to be able to really assess and ultimately react to this convexity or rebalancing problem. Wouldn't you agree, Scott?
Yeah, and I think it's a big thing when it's definitely rate directional. Just on this slide, one thing to point out, this is primary dealers' net holdings of agency MBS. So every month they report to the Fed how much they net hold. And if you look back on the left in 2018, their net holdings were about 20 billion. And those jumped up to about 60 billion net in 2019. What was happening here was the Fed was cutting rates. This made financing costs cheaper and gave you more carry. So this is a trade that dealers got into. This is a trade that hedge funds got into. This is really when the REITs got in. Everybody with levered money got in because the Fed was lowering your borrowing costs. Then what we saw in March was the markets kind of went haywire and everybody had to delever. We saw that with margin calls, and all of a sudden everybody was forced to put up margin and sell assets. But then at the end of the March, Fed came in and said, we're buying everything. And then primary dealer holdings really spiked, mainly because they absorbed supply from investors that were net selling, but also they stayed very, very high to facilitate origination volumes, but also to put on a very, very attractive carry trade. They slowly worn it off down over time, but they're still long $43 billion worth of basis. And I think that's an indication of where the industry as a whole lies. But there's a lot of levered money out there, and a lot more than there was 2 years ago.
Yeah, I guess the thing is that to maintain the integrity of the market, the Fed is not that upset that they grew their balance sheet so much in mortgage product, because if you absorb what needed to be acquired, as well as, of course, you want to maintain, the functioning of the market, and of course, dealers ultimately are still have some role as a backstop in that. So I guess they're not ultimately that concerned, at least for a short-term period, for such a growth in the balance sheets on the sell side in the mortgage asset. Okay, so let me shift forward. So, little observation here as far as the magnitude of this effect. From what I read in preparing this, I was given the idea that in the last 2 months sell-off that we had in the 10-year note, 70 basis points in 10 years, the duration of the universe extended by about 110 billion 10-year equivalents. What we mean by that is the duration that was gained due to higher rates was the same as if you were long additional 110 billion of 10-year treasuries. So you can translate that, if you want, into a PV01 number. How much does 1 basis point increase in yield mean in terms of change in market value? So what we're going to talk about today is both empirical and model-based approaches to arriving at that number, right? What are the components that go into that number? For example, things like, how is the mortgage universe distributed across coupons, right? What's happening to the yield curve when rates are adjusting? How are mortgages performing? Like we mentioned, mortgages strengthened very, very smartly beginning with March or April of last year. How is volatility? All of these various factors are interacting in arriving at this number for what the market assesses to be the extension of duration due to the higher rate level, right? And one important point, which we'll highlight a little bit later on, is like going into a possible rate sell-off, where's the maximum pain point? At what yield level do we sort of see the stock of mortgages exhibit the greatest amount of negative convexity? That's an important point as well. So let's go through these one by one. Okay, so the first one is the stock. here's the distribution of mortgage product right now. I got this from EMBS. So Scott, you want to comment on the fact that it's very, very heavily weighted towards the recent production coupons, the 2s and 2.5s?
Right. I think right now what we've seen over the last year with mortgage rates falling is a lot of people have, 40% of the universe, or 30% almost, refinanced their mortgages that last year. So it moved mortgages from people that had 3 and 4% mortgages down to 2.5 to 3. So the mortgage issuance that's out there and what's outstanding is really skewed towards these lower coupons, but pretty evenly balanced across 2s, 2.5s, 3s, and 3.5s. And I think what we're going to show you is, as rates move up and down, each of these coupons is impacted differently. But one thing I would say when I look at this chart between 2s, 2.5s, 3s, and 3.5s, which all have kind of an equal weighting, is the people that do duration hedge that are long basis tend to be long these 2 and 2.5 coupons, the production coupons we call them, which tend to have a lot more negative convexity, and they're more likely to hedge, where the higher coupons are much less likely to have a lot of basis trading going on.
Right. Yeah. So you can imagine, let's say, a different profile. You have a violent rally or sell-off, and all of a sudden the mortgage market is off sides as far as what's outstanding relative to what carries the most negative convexity. But I guess right now, most of the stuff out there is kind of in this convex kind of cuspy kind of range, which is subject to probably more duration migration than if you basically had another configuration. So that's the stock side of it. How much is out there? And how much convexity does that carry? The next step, obviously, is what have rates done recently? So let's take a look just very quickly. We know what the Fed funds rate has done, right? We tightened. We were tightening beginning December 2015, abruptly stopped, and reversed things in 19. And of course, we had massive easing of policy immediately after the pandemic broke in March. We're back down to 0%. And we all know the Fed has said no real expectation of tightening anytime in the next couple of years. Okay, what about rates? Well, again, we know the story. Massive, massive rally coming out of COVID, right? Pushed yields down to, a little bit around 0.5%. They meandered around then. And of course, we've had this sell off in the last, handful of months. It's funny because one commentator said, well, yields have doubled. Yes, they've doubled, but they're still only 1.6%, 1.7%. But yes, they are significantly higher than they were a couple of months ago, but we're still not back to the levels we were prior to COVID. So you have to take that into perspective. Okay, that's the yield story. What did the curve do? Okay, the curve has in fact steepened. This is important, because if you're looking at any type, well, both from a model perspective as well as kind of market, kind of like folklore, yes, a higher, steeper curve means presumably lower expected prepayments and greater bond extension. So, Scott, you want to comment a little bit about how, whether you're a model slave or you're not, if you sort of see a sell-off with a steeper curve, you could probably, that has to be taken into consideration in trying to judge the amount of extension risk you're going to be facing.
Yeah, and I think the big thing is, and I'll bring it back here to modeling. A lot of what I do is really looking at models and how rates impact it. But certainly, especially in this group, as you're building models and looking at models, the one thing people don't think about is the impact of the slope of this curve, because most of your models, when you run prepayment projections or you calculate OAS, you run all your scenarios, a steeper forward curve, right, is generated by a steeper present curve. When you think about what is the 2-year treasury, what is the 5-year treasury, right? It can be the 2-year, 3 years forward, or however you want to look at it. But a steeper yield curve right now projects higher rates going forward. So when I run my OAS models, when I run my prepayment models, I am projecting far more scenarios in a higher rate environment. Now, higher interest rates on mortgage-backed securities cause less borrowers to refinance their loans. So when we think about extension risk, and we're going to have a slide on this in a second, think about the average borrower, right? If I have a pool of 100 borrowers, and I think that in my base case, 10% of these borrowers will pay off their loans in a year. And my average life might be about 8 years to get my cash back. And that's mainly from people housing turnover. But if interest rates go down, and now I've got 30% of these borrowers refinance, that makes my duration shorter. Conversely, if interest rates go up, my prepayments slow down and I might only be getting 5% of my cash back a year. From that point of view, that adds duration to my bond. It's a much longer asset. So the key thing here when I calculate my durations is to look at the impact that this curve has on my forward projections and on my prepayment models.
Exactly. So basically, of course, you cannot predict what's going to happen in the face of a sell-off. But if you sort of see a sell-off combined with reshaping the curve this way, you clearly there's an implication of that for how your duration are going to move. So now so far we've covered like the stock story, the rate story, and the curve story. What are the other determinants? Well, okay, implied volatility is a determinant, right? Because obviously you're talking about in a variety of ways. One, it directly impacts the measurement of the duration extension, convexity. On top of that, of course, it has a profound effect on the valuation of the product. So as I said, you've got the intrinsic valuation of mortgages that's moving along with rates. And depending on how it moves, wider, narrower, that has an effect on the convexity, that has an effect on the duration extension. So this is a snapshot. I got this from Bloomberg of on a normal model basis, what implied volatility has done. It has gone higher, not surprisingly, in this last period of time in conjunction with the higher rates, but it's fairly well behaved, in the period right after we sort of had incredible jump in it, right around the time of COVID. But so, the question is, you want to examine to what extent has the repricing of implied had an effect on the duration extension. And of course, on top of that, if you are going to be actively hedging, you might explore using derivatives to hedge your duration migration. And obviously, in a higher implied volatility environment, they're going to be more expensive. So the GSEs who were very active users of option product, clearly if they were in the game right now, they would be monitoring this to try to time when they would go in if they indeed were going to try to rebalance using option product. Okay, one more statement as far as the I'm sorry. Okay, again, how a mortgage is done in the course of this sell-off. Well, this is a picture. This is Bloomberg's model. We'll talk about OAS in a bit. The OAS of 30-year current coupons, right? This is the I should have been a little clearer here. This is the current coupon OAS. So it's a very, very generic slide. Well, you sort of see, as Scott alluded to, massive improvement in valuations in conjunction with the Fed embarking on a very aggressive program. We've had a little bit of softening in valuations recently, maybe like 10 or so basis points. But for the most part, it's fairly stable. So we haven't had a massive repricing of the valuation of the asset class in the context of this recent, couple of months sell-off. So that's the valuation story. And here's another picture of it. I just tried to take a look at how does this thing move in relation to rates. Well, not very much to see here, but I simply looked at the movement, daily changes in this OAS series against rates. It's hard to see a pattern here, but I ran the complete correlation for the full 7 months. Very, very small, minus 14%. So the daily movement, the daily change in the valuation of mortgages, at least to the extent that it's measured by this OAS series and the rate level, have behaved fairly in an uncorrelated fashion. Okay, this is the graph that Josh Younger of JP Morgan put together. I find very, very instructive. I won't have time to talk about it very much, but basically it sort of shows the plumbing and the way the mortgage rebalancing fits into the overall picture of rate movements and derivatives usage. So you sort of see formerly GSEs over here. They basically originate mortgages. They issue callable debt. You've got servicers over here that, as I said, typically might use option product to hedge. You've got relative values. Scott alluded to basis trading, taking advantage of attractive funding on the part of hedge funds. But I'm going to skip over this because we have quite a number of slides to cover. So sorry about that. Okay. Again, this market we're talking about is huge. It's sitting over here. It's the blue mortgage-backed securities market across the entire fixed income market. It's a very, very large component. A little picture here about issuance. Mortgage-related is, I don't know, about a third or so for issuance month by month. Daily trading volume, it's a pretty big component, not as big as treasuries, but still very, very big. So we're talking about a major big elephant part of the fixed income market here. Okay. Now so let's try to focus in on exactly what we're trying to do in line with how we understand risk in other fixed income markets, to ultimately get to this number. We talked about the convexity number, the duration extension number. So ultimately, we want to be able to manage it. But first, we have to be able to measure it, right? Well, all these products I've talked about, asset backs, corporates, right? They're all spread product. They're quoted on the basis of spread to some benchmark instrument, right? So in shorthand, what we say is that a spread product like a corporate bond or a asset-backed security has rate risk and spread risk, CSO1, PVO1. Now, at the most basic level, what we want to be able to do if we're a mortgage investor is figure out a sensible version of this for MBSs. So to be able to measure both rate risk and spread risk for an MBS product. And the problem, of course, is, and by the way, and what we can attack this problem either empirically, just simply looking at sensitivity based on historical movements between mortgage prices and rates, or we can attack it in a more model direction. And traders ideally allow these approaches to sort of coexist in their decision making. Okay, so what are the generic risks of a mortgage-backed security? As Scott's talked about this, there are fixed rate instruments. There's rate risk. The key thing is that the rate risk changes because of prepayment response on the part of the borrowers. There is default risk, but on the agency side, it's basically taken out by the guarantee fee that's paid by the out of the gross coupon, and all of these factors interact and lead you to a fairly complicated problem. You're trying to model this duration migration in kind of a probabilistic or kind of like a dynamic kind of way. There are all idiosyncratic risks as well. Where do the loans reside? What's the loan to value? What's the borrower's attributes? So there's a whole array of decisions that have to be made in making sure you're capturing enough of the idiosyncratic and generic factors to be able to ultimately attack this problem from a model perspective. We're going to spend a little bit of time about that, right? But let me, before we talk about the mathematics of it, let's go back and revisit one of the benchmark instruments in the market, which is a so-called pass-through. So basically, is what it is. It's a bond. It's got a CUSIP. It's called a mortgage pass-through. It's backed by a pool of 30-year mortgages, right? Out of the gross coupon that the borrowers are paying, there's a fee that's paid to Fannie Mae to protect against default. Basically, Fannie Mae will buy out a loan from the pool if there's a certain period number of months where the borrower's been delinquent, right? The net coupon received by the investor is 2.5% paid monthly. Any principal that comes in from the borrowers is directly passed through to the bondholders. This is not, however, a 30-year bond, and not just because you're getting amortization over time. It's because we don't know what the principal redemption schedule will be in advance because of the presence of the prepayment risk. So, Scott, you want to talk a little bit about the basic static analysis, how we would look at, let's say, this particular bond in the market?
Great. So the way to look at this, and we talked about a mortgage-backed security. Imagine you've got a pool here of 100 different mortgages. This is Fannie 2.5s, and you can see it's almost a 26 billion. It's $26 billion is this pool. It's all different mortgages, and the cash flows from these mortgages. When you think about a 30-year amortization schedule, everybody pays their mortgage every month. And then all of a sudden, if somebody pays off their mortgage, either they sell the house or they refinance or whatever they do, that cash flow is passed back through to the investors, and then the pool gets it, and then the pool shrinks by that amount. Now, when you talk about average life, what this dynamic right here, this field. Average life tells you the average amount of time it takes you to get your principal back. So if I think about 360 different payments and I think about 10 CPR, so if you look at that 10 CPR number, that's a constant prepayment rate and it's an annualized number. What that tells me is that 10% of my principal will come back on average in the form of a prepayment. So I've got scheduled amortization. If you have a mortgage It starts out, let's say your mortgage payment has a 3% rate and it's a $200,000 mortgage and your payment's $1,200 a month. That payment stays the same. In the beginning, there's much more interest component. At the end, there's much more of a principal component. But what you see is I'm expecting that normal cash flow, but I get 10% extra a year because people either refinance or they move or however it works. Now, if I have 10% of the people refinance a year, my average life is 7.23 years. So I'm going to get, adding all these cash flows up, I get my money back in 7.23 years. My yield on this bond is 2.01% at a dollar price of 103. Now, this is a premium dollar price because the par value is 100. If I get more cash flow back than I think, let's say 20% of the people refinance, right? Interest rates have gone down. Now my average life drops to a 4-year, 4.08 year, and my yield drops to 167. And what we've seen recently this year is actually the speed on Fannie 2.5s have gone up to 35 CPR. Now I've got a bond that's a 2-year bond, 2.28 year average life, and my yield's only 1%. But the main thing to think about from a convexity point of view here is if rates go up like they have now, this bond that I'm buying, that I'm kind of hedging like a 2-year bond, all of a sudden right now might be a 7-year bond. And what that does is it forces me to sell more treasuries if I'm long this bond in a basis trade, because now I've got a much longer duration to hedge. So this kind of talks about the negative convexity of a mortgage-backed security. Because you are short an option to that homeowner, they can prepay at any time, and you've probably worked on modeling options. The main way to look at a mortgage is I'm short an option. And it could be a 7-year, but I could get called. So think about being short a call when you think about how to model these cash flows.
Yeah, imagine if you're in a basis trade. Thank you. Imagine you're in a basis trade. You think you got into the good level, and all of a sudden you lose all your P&L because you rebalance, you messed up balancing the rate risk. I mean, it dominates, right? You could be getting into the basis at a very attractive level, see the basis improve, but all of a sudden you're off sides as far as rates. So what everything you made because you bet correctly on the basis is totally wiped out and actually overwhelmed by the fact that you were wrong, you were off sides on the rate side. Now, this is the static approach. And as I said, people kind of like combine this with the mortgage model approach, which is described over here, which I want to skip over because we're a little bit short of time. So we'll come back to this. Basically, this is the Bloomberg OAS model, which actually gives you a model-based calculation of your convexity right over there.
Right. Actually, Leon, one thing to point out here,
yes.
This is an option adjusted model. So you run, 256 paths. The key things to look at here are this OAS duration, which is 5.35, and my OAS convexity, which is -3. So when I think about my duration, it's how much I expect my price to move. If interest rates move 100 basis points, I expect my price to move 5%. The option adjusted convexity measures that change in duration when rates go up or down. So it's that second derivative of price when you think about it that way. So what this tells me is that I've got a 5-year duration, but my convexity is -3. So I could go down to a 2-year if rates go down 100. I could go up to an 8-year if rates go up 100. So that negative convexity tells me how much risk I have in this bond from a modeling point of view. Now I get paid a lot of yield for that. I get more yield than a treasury security because I'm selling those options. In a low volatility environment, it's very profitable for me. But in these big rate moves, I can see how quickly my duration changes. So that convexity number really tells me how much risk I've got on duration.
Thank you. Right, correct. Now, what we'll do is let's go back to the static approach, and let's take a look basically at, and I'll describe what that is in a second. But well, actually, let me maybe we should skip over this one. Okay, actually, maybe you could talk about this a little bit as well. What I wanted to show was the fact that you can compute this changing rate sensitivity empirically. I'll go through the mathematics of that in a little bit. But Scott, maybe you want to comment on this slide regarding exactly where you think the convexity risk resides and where you want to
Can we go
most
to the
actively
next?
manage.
Can you go to the next one?
Sure,
There you
exactly.
go.
Yes, okay, yeah.
So this is what actually happened in the market. So if we look at this, this is a chart that shows the price of Fannie 2s, which is the yellow line. So Fannie 2s, the Fed was buying them. They were kind of in that $103 price range for a long period of time, really between July of 2020 and February of 2021. So investors kind of got comfortable in here, and you kind of hedged some of your duration, but not a lot. You wanted that extra carry. The hedge ratio, which is that white line down below, tells me how many 10-year equivalents I'm going to be short per unit of Fannie 2s. So when we looked at that convexity number and that duration number, I can see when Fannie 2s were priced at 102, my hedge ratio, which is that white line down there, was probably between 40 and 45%, which means if I'm long $1 billion worth of Fannie 2s, I'm going to be short 400 million 10-year notes, right? That's kind of my hedging cost. What happened here, and again, that's assuming about a 4-year average, a 5-year average life, interest rates went up 70 basis points. All of a sudden, my prepayment expectations on these 2% coupons fell from 25 CPR to about 10, right? Because nobody's going to refinance a loan that's already got a 280 mortgage rate when mortgage rates right now are 3.25. So what happened is that average life of that bond moved from 5 years to 9 years. Now the amount of treasuries I have to sell to be kind of balanced, because now I'm going down like an 8-year bond, went from 45% up to 75%, right? I had a 34% increase in how many 10-year notes I had to sell. So my $1 billion position, instead of being short 400 million, now I'm short 740 million. So what you saw was the swiftness of this move actually had a big impact on how many treasuries I had to sell. So when you think about this, even though a lot of people got caught off guard and said, well, the Fed doesn't hedge and these big hedgers don't, the marginal buyer of these bonds, the marginal player in the basis trade, has a lot of duration risk on and a lot of convexity risk. And I'll say, while the majority of mortgage-backed security holders don't hedge, the marginal player, the active player, does. And I think that's why these moves had a really big impact on the treasury curve and treasury yields. Even though it's a smaller part of the market, what you see in treasuries is there's not a lot of liquidity in terms of the depth of that liquidity pool. So most of the traders in treasuries are high frequency traders from a volume point of view. Most of your traders in mortgages are real money, and they're putting on positions and taking off positions. So when you see a net change in supply and demand, like we saw here, where you could have seen, $20 billion worth of 10 years sold in terms of basis, it had an outsized impact on the treasury market. And then that risk has to get redistributed to actual holders of that risk. So this really points to the negative convexity in the market. And in fact, right now, if interest rates rise further, these bonds don't really extend more because they're out of the money. They're not going to get longer. But now the risk is what happens if we rally,
right? Exactly.
And the bond gets shorter again. Now you're going to see this same buying taking place going the other way. So that's really a good explanation of what happened. And then you think about who that marginal buyer is and who is hedging this. That's really a big impact on the treasury market as a whole.
Yeah, that's right. It basically shows you the bane of being cuspy, right? I mean, who would have thought that a bond would double in duration under a 75 or 100 basis point sell-off in rates, Now, here's the question. How do we obtain this number? As I said, there's this coexistence between model and empirical. So let's take a look a little bit in about 5 minutes quickly, how we obtain this number, this empirical duration. Well, it's actually fairly simple, right? Okay. I'm sorry, let me jump ahead here. Okay. Well, if we had a reliable history of mortgage prices, we could do a regular regression, which we do, and that's the origin of this empirical duration that Scott talked about on that Bloomberg graph, right? So let's take a look at it. And the advantage of that, of course, is it's not model dependent. It's purely based on reliable, authoritative prices of the asset class. There's advantages, of course, that we don't expect to see very, very tight relationships because there are many, many other drivers of MBS prices beyond just simply the rate level. So here's a snapshot from Bloomberg of these empirical durations. So Bloomberg is saying right now that Fannie 2s, right, the hedge ratio is three 348%, 2 years, 70%. So basically, if you own Fannie 2s right now at this dollar price, you'd have to hedge it with 70% of the face amount of treasuries. So this is basically an empirical duration snapshot created in the following way. Okay, so here's a price history of rolling price history of the front month TBA across the coupon stack, 2.5s to 3s, going back about 5 years, right? Okay, here's empirical duration. I'm doing a regression. I'm doing this regression. Price changes in the mortgage regressed against changes in rates, right? This is the slope of the regression line, right? So this is the empirical beta based on rolling windows. And you sort of see, of course, as rates drop, empirical duration goes down. As rates sold off the last handful of months, durations are higher, right? Now the question is, how much does this movement of rates explain the empirical duration? Well, here's a 3-month rolling R squared. Not that great. In fact, there seems to be total breakdown recently of this empirical duration. So if you think about it, how much confidence do you have in this numeric empirical number properly conveying your rate risk or the adjustment of your rate risk when rates reprice, when you sort of see a deterioration of the correlation between mortgage prices, price changes of mortgages, and price changes of yields. So we didn't interrogate this, but something must have happened here. I mean, maybe it's because of all dislocations pertaining to COVID, where there was a breakdown. So for a period of time, 70% or so correlation between, between the level of rates and this empirical duration, but there was been a breakdown. Okay, so what's going on? Well, okay, so what's really going on is that there's more to the story than simply rates. Other things are happening in the background, whether it's mortgage revaluations changing, implied volatility moving, or whatever, that's having an impact beyond just strictly a response of the mortgage's duration to interest rate level. Okay, so a little bit of overview of what we look at when we approach the model. We try to characterize all contributors to prepayments. They are, pertaining decisions regarding the borrower. There are other drivers as well. We model housing prices and sort of things like that. But what I want to get to is like a postmortem of what happened in some earlier periods of time when we sort of had a exaggerated movement of rates, which people quote unquote blamed on the mortgage rebalancers. Well, look at this picture over here. This is a graph from Fannie Mae. We're looking at basically the sensitivity of prepayment speeds in 2003 on product that was created in 2001. So this is basically a highlight of what happened in the early 2000s. The Fed kept rates at 1% for about a year until June 04. Massive increase. Look at how high speeds were, prepayment speeds were on 2001 production product 2 years later. So if a pool was 50 basis points in the money, prepays were coming in at 60 CPR, and as much high as 80 CPR when rates were 100 basis points, when advanced 100 basis points. So in other words, I guess Scott, maybe the early periods of the media effect, perhaps, would you say?
I think a lot of it was, when you get people that refinance once, they're more likely to do it again. And I just think that rates fell so far in 01 to 03. Plus, there was very lax underwriting standards.
Exactly, right.
Streamline refi. I think if you look at what's happened over the last 4 years, you've actually seen this curve increase each of the last 4 years. And it's really due to technology and the ability to automatically underwrite loans.
Right.
And there's certainly an ease to the process with like Rocket Mortgage. So there's a lot more people that can refinance easier. And that allows more refinancing to take place.
I mean, imagine this, you're talking about a loan that was 2 years old, 100 basis points of incentive coming in at 80 CPR. It's unbelievable to think about this, right? That a borrower who's only 2 years into the note, the pool is prepaying 80% CPR. Is remarkable. Now, that was one interesting postmortem to revisit. Now, what was the impact of this? Well, we had this amazing story of so-called duration gap. This prepayment burst had a profound effect on the agencies because they got very, very quickly off balance. Essentially, their assets prepaid much faster than their liabilities. It was a very, very big issue. There was great concern about the equity price. They quickly went in and they tried to adjust this, but it was a very, very big story in 2002-03 that the agencies, who were huge holders of mortgages, and yes, they are actively rebalancing, but at the same time, they got caught off sides by this profoundly higher level of prepayments than their models probably led them to believe. And as a result, they quickly got into a position where their mortgage duration, the duration of their assets was, I think, between 6 and 9 months shorter than their liability. I remember being on a phone call when I was at Goldman Sachs in Risk with the Fannie Mae equity analyst, and the equity analyst said, well, it's not so bad, because what's happening is, yes, they have to buy product to bring them back in line, but the prepayment burst led to cheaper mortgage valuations. So when Fannie Mae buys mortgages to bring themselves back in line, they're buying their core product at cheaper levels, which obviously is good for earnings. So we're trying to basically make the rebalancing requirement actually be more benign in any event. Now, another period, 2006, we had a rally then, right? This was a comment from Nomura that in early part of that year, this was the amount that the mortgage universe duration shortened due to the rally. Phenomenal amount, right? 600 billion 10-year equivalent due to the rally that we had in the early part of 06. Now, what are people saying today? Okay, well, this is a sort of complicated picture. This is a picture of JP Morgan of where REITs stand. They're arguing that actually REITs are not as exposed right now to this extension risk with the higher rates than maybe in previous times. They're sort of saying that they're currently not I'm sorry, what's the point? Yeah, right. So they're saying that actually they were very, very negatively convex in 03. They've delevered, of course, and so on, but they don't sort of feel right now that they're a big contributor to pressure to rebalance. I'll skip over this because it's a little bit complicated to explain, right? What about banks? Well, the market consensus is that banks actually are not that off balance, right? In fact, they're arguing that in the rally we had last year, right, they're actually short 1.5 million 10-year equivalent. So actually, as rates went up, they moved in the favorable direction. And on top of that, as the curve has steepened with this sell-off, they're in a position where they actually are enjoying, higher net interest margins due to higher yields. So actually, two of the main players you want to interrogate to see where they're being exposed, the view is sort of benign right now. Scott, you want to comment a little bit on depositories and where they sit on this duration story, convexity story?
I think right now the depositories they're pretty much, they buy and hold. They really don't stray too far away, but I think right now they're looking for shorter duration, higher cash flow, but it's much less of an impact on the treasury market. And when we're talking about our discussion today with regards to hedging, I definitely think the REITs, the hedge funds, and the bank, the broker dealer side are your biggest components here. But certainly the banks are actually a bigger buyer than the Fed. And between the two of them, there's not a lot of dynamic hedging that takes place, but there's a lot of demand there, which is keeping spreads tight for sure.
Okay, so to sum up, since we're going to go into a little bit about the basics of the mortgage model, but instead of doing that, since we only have 6 minutes left, let me just sort of summarize by saying that it seems from what we've studied that the core risk really resides more on the sell side, the levered basis players, not so much on the traditional total return buy side investor mortgages, who sort of seem to be fairly well positioned. Doesn't seem to be an exaggerated extension risk. So maybe this opinion that we can't really blame the rebalancers maybe has some validity to it, perhaps. That's kind of like seems to be the consensus view. Although friends of mine have told me that there are people who are arguing on the other side, that actually rebalancing has had an effect and has exaggerated some of the sell-off in the rates. But what we want to convey is the fact that it's a complicated issue. Many things are interacting with each other when to try to measure this, whether you're measuring it empirically or you're measuring it through a model approach. And you have to sort of keep tabs on how other things are moving in the face of a rate move to make sure that you can be more proactive in managing this duration risk. So I guess the bottom line is maybe the jury is still out, but it seems to be the case that the consensus is that actually there seems to be less dependency on the mortgage rebalancers in their influence on the directionality rates. Well, Scott, would you agree that on balance, it seems to be a little bit less of an effect, although you did point out the fact that you do have some levered players in the basis or whatever who actually are subject to this risk and have to be aware of it and manage it.
I think that I'll take the other side of that. I'll say they still have an influence. It's not the primary driver. I think it acts more to accentuate moves. And the real reason I think right now mortgages have been the most negatively convex, right around 150 basis point yield on the 10-year. And that convexity zone was really 1.25 to 1.75. And I think what's happened this time is the key technical levels lined up with some key technical levels in the treasury market.
Right.
So it was kind of an add-on, kind of a pile-on, so to speak. So I think it wasn't the primary driver of moves in rates, but it certainly helped push us through some key technical thresholds because you had an extra seller of bonds at key points. And a lot of those were right at 125, right at 140, right at 150 and 160. So it kind of exacerbated those moves. So I think they still have a big impact, again, because of the lack of liquidity and depth in the market. But I think it's a secondary driver, not a primary driver.
Thank you. Yeah, so the remaining slide, which we won't talk about, tell you a little bit about how mortgage models work, the S-curve and so on, right? In a case, yeah, these people helped us with the talk. So thank you again for listening. We hope we sort of conveyed a little bit of the interest in convexity and kind of a very wonderful place where market sentiment, market experience, models, data analysis all interact. So we hope we sort of were able to convince you of that. Any questions in the remaining couple of minutes about this?
I have one.
Sure,
So
Peter,
you
go ahead.
mentioned a few times that the Fed doesn't hedge. Is there any theory as to why they don't hedge?
They just literally buy bonds and put them on their balance sheet. And what they do is they borrow money from the Treasury basically, and they just pass through 100% of their earnings back to Treasury. So it's just purely cash on cash.
Okay.
They're buying.
Yeah. So your provocative title, sort of suggests that like it's always a surprise that these mortgage rebalancers, affect the market. But one could take the view that the Fed, who changes interest rates, is well aware of the existence of mortgage rebalancers and takes their rebalancing into account in, and so let's say that the volatility we experience is exactly what the Fed intended, understanding that there's going to be this rebalancing effect, this effect from rebalancers. Any thoughts on that comment?
I think the Fed is focused more on liquidity.
Okay.
And providing just, they don't want to really impact the markets. They want to just, here's what we're doing. We're going to be very methodical. I think that they're cognizant of what's going on, but I think right now they're much less concerned about the mortgage hedgers and things like that. They're thinking about, how do I support liquidity in the market? How do I keep interest rates in control? And by doing that, they're saying we're going to buy 40 billion mortgages net a month, and we're going to reinvest all of our cash flows, and we're going to buy 80 billion treasuries a month. And they're more concerned about where they want to be on the curve for treasuries from the yield curve. But I really don't think they really focus on the hedging activity that takes place. And again, it's such a small part of the market. It just has a big impact at certain points. And I think to Leon's point before, I guess we talk about the marginal hedgers today. The real difference when you think about who the large marginal hedger was that had an outside presence in the market back in the 90s and 2000s was the GSEs, right? They had the government guarantee on the debt, right? It was an implied, not an explicit. And they could buy as much as they want, and they funded at LIBOR less 50 because of their callable debt program. So they funded better than anybody else. And then they issued callable debt against mortgage-backed securities. They hedged a lot of that with swaptions, but if you're on the other side of that in the market, you have to hedge your swaptions with rates, right? It's just like a normal option. So you had a much bigger player that was a primary driver of moves. I think today you've still got a very influential player that's a secondary driver. But I think the Fed, they're buy and hold because they just buy assets and they don't want to be an outsized player and have influence on flows other than what they buy.
Yeah, to reiterate that, it's scary when the marginal buyer who has cheapest funding is levered and can take paper out of the market at tighter levels than everybody else. That's a recipe for disaster, obviously, as we saw, because, all the things are lining up for them to be able to buy paper at expensive levels, cheaper funding and leverage, right? Well, it works both ways, right? So, and now I guess, you've got another area of players who are sort of in that similar position, exploiting whether, strong rolls or cheap funding or whatever, and taking advantage and to be able to utilize leverage, right? And maybe they're buying product that maybe isn't necessarily that cheap. So, as I said, the being wrong on rates can overwhelm any kind of relative value call that you make, which is correct. Would you say, Scott, to some extent?
Yeah, I think, to your point, the Fed is the largest non-economic buyer in the market, and it's tightened spreads to the point where anybody else has to really be nimble.
Yes.
And there's not as much cushion to be wrong, which means they hedge much more dynamically. And that's really what you saw in March, right? Everybody had the basis trade on, and it worked until there was a hiccup in the market. And all of a sudden you had margin calls and treasuries rallied 150 basis points, and everybody was offside on their duration and their hedges. And I think that exacerbated the move down, certainly as these guys took off, that were long the basis went the other way. But obviously, your big blowups, and you go back to the financial crisis, typically aren't like junk bonds or low quality bonds. It's high quality bonds with a lot of leverage where you're making up for the tight spreads and volume, and
Exactly
that's where your blowups happen.
Exactly.
All right.
Yeah, I have a question here.
Oh, go ahead, Armand.
Yeah, it's Armand. Hi. Yeah, it was a good talk. It covered a lot of ground, so it was very well done. I have a question about I guess what's happened with the swap spreads due to the mortgage hedging. Is that something would you look at, Scott, when you look at
I think swap spreads today have less to do with mortgage hedging. I think most people in mortgages, because it's so expensive, hedge with futures, which are tied more into rates. I think swap spreads right now, a lot of it is capital based. We saw the Fed did not extend the SLR exemption for treasuries and for reserves. I think a lot of that got priced in. I think a lot of the swap spread move has really been driven by people's outlook for rates. You saw swap spreads widen as people started to price in Fed hikes. But I think the move in swap spreads is much more driven by, SLR and banks. And I think on the long end, certainly driven by all this corporate issuance. I think these treasurers and a lot of the pensions, looking to add duration out there, certainly is having an impact. But I think swap spreads is probably not really driven by the mortgage hedgers right now.
Yeah, because I thought perhaps over the last, I guess, the last backup that instead of people selling treasuries, they were paying in swaps, which is causing swap spreads to.
Well, I'll tell you, but I asked that point. I talked about that point with my former colleague from Goldman, who's now at the World Bank, Arvind. He said, when I asked him this question about the convexity, but he said, he thinks that if people believe swap spreads will widen in a sell-off, that exaggerates this problem. For the reason Armand just said, you know what I mean? They're whacking the market in swap land, right? And they're afraid to get out as quickly as they could because they think the spreads are going to widen even more as rates back up. But he said he thinks that because that has not happened. That is people taking a more benign view, precisely because they're not as afraid that swaps they'll lose control of swap spreads in the face of a sell-off. So that was his perspective as one reason, mitigating effect,
Yeah,
mitigating factor of the rebalancing issue, because they don't believe you're going to have a gapping wider swap spreads if we have a rate sell-off. And in fact, we haven't had it. As Scott just said, it has less of an effect.
yeah. I think swap spreads are driven much more by balance sheet and really corporate and insurers. I do think too on that note that when you think about how fast we've moved and how quickly we need to do, swaps are contracts, and it's just way easier for a mortgage desk to hedge in futures where there's instant liquidity.
Yes.
We need to wrap up actually,
Okay.
but before we go, I just want to thank you both for a very interesting talk. And I also want to point out that Leon very correctly put both of his affiliations in the proper order, and why you can first and then why you can second. And so with that, Abby, could you hit stop record?